Hello, everyone, and welcome to a very special episode of the Property Trio. Today, we're talking about our 2024 predictions, the year that was, and it's a chance for us to shine, to be in the gutter staring up at the stars or in the gutter staring down at the elaborate drainage system. That's not a metaphor. I'm going to try again, but luckily I've got two co-hosts who are probably much more eloquent with their metaphors, Kate Bakos and David Johnson. How you doing?
Great to see you, Mike.
Morning, guys.
Well.
I'm just trying to throw in a bit of, Oscar Wilde, class it up a little bit. But let's get down to brass tacks. Predictions for 2024. The first sort of question that we tackled was, what will the market do? And I think maximum points to you, Dave, for throwing it all on the line. You said, and this is, you're going to love this one. I think we'll see value growth of about 2 to 7% nationally next year. I think the market will be weighed down by Melbourne and Sydney as they're starting to move into negative territory. It's going well so far, Dave. Yeah. There'll be some good buying opportunities in Melbourne and Sydney for the first 3 to 6 months, but because they are about 50% of the overall Australian property market, I think they'll hold it back, and I think rental growth will outstrip value growth. Gosh, we should just end the show on that. Just mic drop.
He did well. And I like that he was specific, quoting percentage ranges.
I must admit it was the broadest percentage range I've ever used, so I've learned that lesson. It was covered a bit more territory. Yeah. The pin was so national growth was 5.5%, so it was almost in the mid-range.
Had it been 4.5%, I would have been super impressed.
Yeah,
I reckon as a challenge for your 2025 predictions, we make it like a 3% margin. That way, if you went up by one and down by one, and if you got it in there, which you did. Kate, you said Melbourne and Sydney will slow down the pace of our national median house price growth. If that happens, we can expect some good buying conditions. And when I say good buying conditions, maybe a buyer's market for the first few months. You got through that fairly well as well.
Yeah, I did. Probably a bit more general than Dave, if I'm being completely honest. And, I said the first few months, I actually thought that our buying conditions were great all year round. It didn't get stronger towards the end of the year at all.
Yeah, nothing really sort of seemed to change too much. We had the rapid pace of growth in places like Perth and Brisbane and Adelaide, and that just sort of tended to tick all the way through to November, I think, is when we really saw the first sort of sign of weakness, would you say?
Yeah.
Oh, look, the speed of growth was starting to decelerate, I think, from around August with some of those capital cities. So, yeah, I guess it depends on your definition of weakness. I think, was it Brisbane and maybe Adelaide both dropped under 1% monthly growth by the end of the year?
Yeah.
And well, I'll do yours, Mike, if you like.
Sure.
So, Mike, you said economists broadly, as presented, I think, by the Fin Review, said between 1.5 and 8%. That was kind of the range. So I expect property prices to either test or break the upper limit of that range. So I'm probably saying, 7 to 9%, which is pretty strong. So you're only just above where we ended up.
And I think, here's me making a case for why, in retrospect, it was a brilliant thing to say. The expectations were for an interest rate cut, I think, at that point in time. And had we got that, maybe that would have saved me. But, yeah, look, the only thing that I can say in pleading my own case is that I expected it to be solid. And I think apart from, a couple of markets that were really in the doldrum, like if everything just did like what Sydney did, like the non-3 charging capitals, I might have had a chance. But, you guys gave me a toweling on that one. So as a recap, and as Dave mentioned, we saw national price growth of 5.5%. And I think we'll award the maximum marks to you, Dave, on this one, not only because you got it right, but your range was actually tighter than the economists predicted at 1.5 to 8%. You did 2 to 7%, and you got it. So well done.
Yeah.
Thank you.
Agree.
And actually snuck it into rental growth for annually just pipped the capital growth of the property values. Rental growth was 5.8%. So I got a bit lucky there.
Gosh. Yeah,
Just
I didn't even ask about that because I thought it was a lot higher than that, actually. But it's just, I mean, we got so focused over the year of looking at Brisbane, Adelaide, Perth, just month after month, because that's where all the action was. Let's have a look at the capital city top performers. Now, Dave, you said just really following current trends, I think Perth will be the top performer. Brilliant. I'm going to stick with Brisbane as number 2, and I have Darwin as a smoky wild card. So if we look at the scorecard, we had Perth at 21%. We had Brisbane almost tied second, but actually came in third at 12.1, behind Adelaide at 14%, and Darwin 0.9. So it was a very, very smoky wild card. But, good on you for swinging for the fence.
Yeah, I might back up this year again with Darwin as a smoky. It's got to come good one of these years.
Yeah, I love it.
Just keep doing it. Just keep putting it all on black, Dave.
Yeah.
Kate said, I'm going to go with Adelaide as a city that nails it. While I feel the momentum, that Perth will do quite well, I think that Brisbane's got a lot of momentum. So, I mean, you've spoken about the 3 top performers. Adelaide came in second to Perth, but when you said I'm going to go with Adelaide as a city that nails it, I mean, it did nail it. I mean, 14% growth is solid.
Not number 1, but yeah, Adelaide's just that city that's kept on keeping on, and there's a lot of reasons why, Adelaide's doing so well, and sentiment counts for a lot, but it's become a very cool city. I've got to say, if you've spent a bit of time in Adelaide, it's come a long way over the last 10 years, particularly for people that are visiting it and enjoying it. So, and there's a lot of job creation there. I'm probably giving the game away a little bit. I think that Adelaide's still got steam in it for next year as well.
Yep, keep your powder dry. But you heard it here first.
Do you know what I love?
Dave
and I didn't put Melbourne on here, and we all sort of know that Melbourne hasn't had some great growth drivers showing themselves up recently, but I've always had that sense of wanting my city to do well. It's like a confirmation bias, and it's not great to carry that, and I've tried very hard. I remember this time last year when we were putting together our ideas and our tips and guesses, I didn't want to have any bias come into this, and I think it's one of the first years I haven't put my home city down. And I'll keep my powder dry about what I think Melbourne will do next year. But Dave and I haven't mentioned Melbourne once.
Kudos to you, Kate.
I'll try. Now, Mike, you
go for it.
You said I'm going to pick Melbourne, Perth, Sydney before Adelaide. I think Sydney might surprise us.
Brisbane, sorry.
Brisbane, yeah. Oh, don't throw Melbourne in
sorry.
there.
There you go. Your confirmation bias. Put Melbourne.
Pick Brisbane, Perth, and Sydney before Adelaide. I think Sydney might surprise on sentiment. And then you said, I think there could be a Hobart bounce back. I mean, It's been whacked pretty hard and it's still a relatively cheap median price. Got to say, there's been a little flicker of light very, very late in the year for Hobart. Probably too early to call it. But interesting that you had that thought. And the median price, relativity speaks volumes when you're assessing a market, particularly if you're an investor. But tell me, what was the basis for Sydney surprising on sentiment?
Look, I just think Sydney is one of those perennial performers. It's a market that, I remember times where people saying the median house price in Sydney will never go above $1 million because it's just too much of a psychological minefield, or the income to asset price ratio will never go above 20% because Sydney can't afford for that to happen. Yet it keeps breaking those things, and it's such an internationally recognised and desirable city. And I just saw that there was, there were certain subsets of the market that were making money. I mean, we've talked about 2024 as a cost of living crisis, but it's really kind of a two-speed cost of living crisis. You got the people that are crunching their numbers saying, can I afford the groceries this week? And then you've got the top end of town going, is there a crisis? Oh, wow, I was wondering why things are cheaper. You know, it's just a little bit weird. So I don't know. I felt there was a lot of Sydney bashing going on at that particular point in time. And I just sort of thought, look, I don't think it's going to be that bad. And as it turns out, I mean, apart from the big three, it was the only city that really kind of did something. So, you know, I was almost there. But yeah, Hobart, just way too early. But, you know, for 2025, I think it's got a chance.
So if we recap the annual results for 2024, now this is December to November. So December 23 to November 24, we had Perth 21%, Adelaide 14%, Brisbane 12%, Sydney 3.3%, Darwin 0.9%, and then in the negative territory, Canberra just 0.1%, pretty much flat. Hobart -1%, and poor old Melbourne, bring up the tail, minus 2.3%.
Yeah, ouch.
Yeah, it's sad. But I mean, you guys are Melburnians and fans of the great city, but could see the writing on the wall with the sentiment and, you know, the state political situation with housing and
just
debt,
got a bit more
tax.
fun.
Yeah, I know.
Oh.
Yeah.
Doesn't Victoria now have more debt than every other state combined at this point in time?
Thanks for that reminder.
Yeah, I'm not sure if it does more than every state combined, but it certainly has more than its fair share. That's
as soon as we hang up, I can see your Google search history already. Let's
But look, none of us had Melbourne, did we? Not one of us mentioned Melbourne, so we're on the money there.
I think the tax legislation, it just was
off the back of lockdowns.
Punch, really.
It was, yeah.
So I think, I don't know, you guys are probably in tied first position for that one. Pretty well done.
You did solidly, though.
Yeah.
Credit where credit's due. You had Brisbane and Perth up there.
They were the big ones.
Sydney and Hobart let you down.
Yeah, Sydney dragged you down a bit. Then you went out with Hobart as well.
That was smoking.
Too many options.
That was too. Yeah, I know. I've got a lesson to learn for 2025. When we talk about regions, we didn't really specifically cover off what we sort of thought from percentage points or which actual regions in which states. But Kate did say that New South Wales has a couple of very big cities, or quite a few, and I think we'll see affordability constraints forcing Sydney-siders to look at all alternatives. Kate, how would you mark your own test for that one?
No, I wouldn't give that a pass, and I'll tell you why. New South Wales combined regions for 12 months did 3.2%, which is not setting the world on fire. That's, literally, just about in the inflation band territory. And what I didn't capture, which I should have, but who knew, WA, South Australia and Queensland, those regions continued to go crazy. And I didn't pick that. I actually thought that those regions all went nuts during COVID and that there'd be some sense of calm. But what it screams is that either people are selecting regions to move to, or we've had a lot of investment activity. And you don't need a lot of investment activity in regions to push up the numbers markedly, because we're talking about much smaller numbers. And I know that there's been, a lot of people based on price point chasing investment in the regions, and particularly in these locations. But I did think that New South Wales would show more of an internal migration from the capital city to the regions from an affordability point of view. But I'm not going to give myself a dud score on that point, because I know how many Sydney-siders have been moving to Melbourne. Well, I don't know exactly how many. I know that there's been a much larger number of them. So anecdotally, I'm dealing with a far higher percentage of people from Sydney saying, guess what? We can get our jobs transferred down to Melbourne, or we can work from home, or we can find new jobs. And they're doing it. I've helped a large number of clients this last probably 24 months move from Sydney to Melbourne because of the cost of living.
Quite a price differential now between Sydney and Melbourne, right? So
Huge.
I was sort of equated to like the retiring in Bali phenomenon. You own a street or, you know, a little box in Sydney's inner suburbs.
Yeah.
One thing that played out this year was the regional movements of each state almost exactly reflected the capital city returns. So, you know, that's something to watch out for. Is that something that's going to continue, or are they going to bifurcate again and regions sort of operate at a different speed to the capital city in their state? But this year they're very similar.
Very. And there's only two things I can think of. Either people are being forced out of their capital city as the values are growing and they're downsizing the budget, moving to the regions, and the regions are still experiencing that same knock-on effect, capital growth, because of demand. Or is it investors looking generically at a state and saying, oh, I want to invest in WA and, you know, I don't want to spend $900,000 or $1 million in Perth, so let's look at something for $450,000. I don't know, and I'm sure there's someone that can answer it.
Yeah, look, I feel like it'd be those two things as well. And then also investors inside of that state who live in that capital city who go, look, I don't think we can get bang for buck in the capital city, so let's invest in one of the regional locations. And just
we'll
moving lock and
I
step.
agree.
Yeah.
I know that yield plays a big part, not just affordability and borrowing capacity, but yield plays a huge part for a lot of investors. And they look at something and think, I want to have as close to cash flow neutral as I can, or I'm going for something cash flow positive. Out of all of the cities that we could target that kind of performance, and this is a very general statement, but you're more likely to get it in regional WA, regional SA, and regional Queensland than any other state.
I think that's a good
maybe
point.
Northern Territory, but
but we're all a little bit scared of Northern Territory. I mean, if people are scared about WA for its resource reliance, then Darwin is WA on steroids. But I sort of thought of 23, 24 as years of affordable markets, and you know it's different now. Like WA is not as affordable as it was. From an income to asset price ratio, some of the research we've done is saying it's still got legs. It could still actually grow quite a bit. But yeah, it's interesting. We have regional WA in top position for the past 12 months at 17.1, and then we had Queensland at 11, South Australia at 11.6, I think it is, and Queensland at 10.9. Queensland's really quite different to me. Obviously, WA and Queensland are both massive states, but in WA, I think it's around about 3/4 of the population live in Greater Perth, whereas Queensland's got those markets sort of dotted up the coast, you know, like the Rocky and Townsville and Cairns and those sorts of places. And anecdotally, I've seen a lot of investors going into those places like Mackay as well, and chasing, I think, the two things, the affordability and the yield.
And then you've got the Sunshine Coast, and then I think Gold Coast includes the CoreLogic includes the Gold Coast in Brisbane numbers, I think. But if they don't, there's just a lot more sort of major regional centres across Queensland, isn't there?
Yeah, I think the Brisbane LGA, our friend of the show, Melinda Jennison, called out how massive that actually was as a statistical area 3. So it's a bit problematic to look at that in isolation and understand what's happening in those little pockets. So that's a bit of a bit of insight into being careful if you're looking at those numbers.
Yeah, I actually think that we need to have a change with how we report our leading or larger cities, because leaving out the Gold Coast doesn't make a lot of sense to me. We've got some regional patches that are bigger than some of our smallest capitals.
100%.
All right, investor numbers.
Let's have a word to CoreLogic.
Yeah, well, we call them out every second show. It'd be great if they did this, or I wish they would do this. And I think it's clear they either don't listen or don't care, possibly both.
Maybe we can get some marketing dollars every time we name drop them.
Yeah.
That would be good. Yeah, I'm
Sponsors.
sure they've got deep pockets too. Yeah. Investor numbers. Dave, you said, I think they'll stay broadly consistent with what they've done mostly for the last couple of years, to be honest. We know anecdotally there's a number of investors selling to get out of the market, but we haven't really seen that play out in terms of percentage of people buying. I still sit around 65% owner-occupied and 35% investors. I'm going to give you a chance to mark your own report card there, Dave.
Yeah, look, it did change to some degree this year. There was a movement, actually, an increase in investors, wasn't there? So,
It was. None of us
yeah.
got that.
No.
No, we sort of expected it to go the other way, didn't we?
We
But it
did.
just showed how people were feeling that it was affordable and a time to get in the market. But a lot of that was Perth, Brisbane, Adelaide. At the end of the day, they must have driven those numbers significantly.
Well, it was almost a 30% increase in investor activity in 1 year. That's massive.
From
None of us
financing
got it.
perspective.
Yeah, I
Yeah.
was going to say, where were we on that one?
Yeah. Well, what do we put it down to? Personally, I think that the interest rate scenario just calming down and staying, well, rates have been on hold now for over a year. I think it gave people a chance to accept the new norm and to also be able to sort out their financials and get an idea on borrowing capacity without this target moving all over the page like it was the year prior.
I think the way that we can weasel our way out of this, which seems to be the goal for everyone that I've gotten wrong at least, is that we're not necessarily talking about the net position of investors. We're not sort of balancing the exits versus the entries. I think if we were to do that, we probably did see a year where more investors exited the market than we've previously seen. That probably kicked off with the Queensland land tax announcement. I mean, that was legislated and ultimately repealed, but we saw it in our own data, people voting with their feet and investing in WA instead of Queensland. So I think in certain markets like Victoria, for example, in one of our research projects, we realised that there was basically a 1% drop in the rental stock. So it was, 5,000 people exiting and, 4,000 people entering or something like that. So I think that might have saved us a little bit, but I still don't think it would have done enough of the heavy lifting for it to make sense.
Well, look, I think the other factor is quite possibly more about less people buying new owner-occupied properties. And so if less people are buying new owner-occupied properties proportionally, and so the number of investors stays similar, then the differential is going to be greater. And I think the cost of living is more largely felt, obviously, when you're going to upgrade a home or buy your first home, although we know first home buyers were sort of around historical averages. So it was probably the upgrader who went, look, it's just too expensive. Cost of living's too much. Don't want to take on all that extra debt. We're going to renovate instead, even though that's expensive, but I don't want to go through all the selling and stamp duty. So it's quite possibly that, the owner-occupier is what's distorted those numbers for the percentage of owner-occupiers to fall and the percentage of investment to increase.
Yeah, look, I also look at the impact of the wealth effect and just how many new recipients have experienced significant growth and thought, well, let's do something with this money. Because if we look at Perth, that it's a sizable city, and I've had a lot of investors from Perth looking at Melbourne, so they're feeling the wealth effect. They've got equity, let's spend it. I've also had a fair number of people from Adelaide, and of course, I've had a lot from Brisbane. So, those areas that have done really well, they have been actively spending, and maybe they like to spend in their own backyard as well.
So when it comes to those investment numbers, I think, Kate, you were observing at the time that there were investors that you were dealing with were fewer in number, obviously with working in Victoria from Sydney, had a couple from Brisbane and a few overseas people. I sort of thought that the political intervention would really see investors staying clear of the market, and I think there's been a few stories where they've maybe dodged different states, but across the board, I think we probably all failed on that one on investor numbers. But the good news is there's more to come. Dave, I think you jagged the percentage of investors buying fairly well, but let's see if there isn't some rosier results in the next section, which is government intervention in the property market. So Dave, you said the government will continue to try and pull more money out of the multi-trillion-dollar super industry. And the report card should show the government proposed increasing taxes on high balance superannuation accounts in February 2023 and was legislated in 2024. So
That probably doesn't count. That was already proposed.
Yeah, it was on the
Okay.
wall. Yeah.
Sneaky.
Well, I don't know. They legislated, I guess. So.
Well, we'll give it to you. Specifically for super accounts exceeding 3 mil, the tax rate on earnings would rise from 15% to 30%. So the idea there is to make sure that superannuation concessions are more equitable, and it's projected to raise 2.3 billion annually by 27-28, which is pretty massive. You said they'll probably tinker with laws around taxation and make build to rent more profitable. The government did introduce tax incentives to encourage investment in the build to rent sector. There were changes to Division 43 capital allowances from 2.5% to 4% per year, reducing the final withholding tax rate on eligible fund payments from managed investment trusts down from 30 to 15%. So obviously those incentives were designed to boost housing supply. The build-to-rent sector tax changes were initially scheduled to take place on the 1st of July, but they've experienced a delay. The legislation, which is the Treasury Laws Amendment Act or the Build-to-Rent Act of 2024, the Capital Works Build-to-Rent Misuse Tax received royal assent on December the 3rd, so only recently. Consequently, the measures are now set to commence on the 1st of January 2025. I don't know. Are you happy with that, Dave? I think that's pretty reasonable.
Yeah, look, happy enough. I think they weren't out on a limb. Predictions, I think the Labor government would probably fair chance to try and get some more money out of superannuation, particularly the higher balances of super. And, they've been trying to get funding and finance to increase supply of property in that space, and they haven't really managed to influence that. But, I think build to rent is certainly something that, the Labor government has tended to lean into a bit. But at the end of the day, that's, big international corporations owning more of our property. But they certainly put in some legislation around that to make it easier and more profitable, really.
Moving to you, Kate, you said, I think we'll see a broader array of equity-driven initiatives, so shared equity schemes and a greater variety of them, and probably more thoughtful rules around that. We had an episode just a couple back about shared equity. Of course, we saw legislation passing through on the 27th of November 2024. That's pending, I guess, royal assent. The program will commence once the program directions are finalised and enforced. As of now, the exact start date has not been determined. So you jagged that one for sure.
Yeah, look, it's become the jungle drums were beating. I don't think I would have been the first person to think that shared equity schemes are going to get better and become more mainstream. We had already seen some smaller models around the States, and Homes Vic was a very early adoption, and lots of rules and very specific and difficult to navigate, but a great program. What I probably didn't clearly articulate was the deposit guarantee systems that are out there, or incentives for people. And I think they're fantastic. And we've broadened that. I think it was budget night when all of that came out, and we extended the offering beyond just first home buyers. And I think that there's still a lot of room for this space.
Yeah, I think so. And I think there'll be more and more requirement, really, if we still hold those values as a nation, that home ownership is something to aspire to and something that people want to really covet. Who wants to give me a toweling for my predictions?
I don't think you get a toweling this time around. I think you did well. They're putting tax on overseas investors, right? So they're probably going to look at vacancy taxes. Well, you got that. And there's quite a few articles and points to share here. So vacancy fees for foreign-owned properties. existing vacancy fee. Foreign owners of residential properties are required to pay a vacancy fee if their property is not occupied or rented out for more than 6 months in a 12-month period. That was updated in April 2024. Fee increase. The government announced a doubling of vacancy fees for all foreign-owned dwellings purchased since May the 9th, 2017. I remember when that came into force. It was quite nasty. The increased vacancy fees apply to all vacancy years starting on or after April 9th, 2024. And we've got some individual state details, which I won't go into. Another one that you came up with, Mike, was there's a real risk of rent caps, horrible things like that. Well, the Greens have certainly made a song and dance about it. And that's one thing that we haven't really talked about, the influence of the Greens on some of our policies and legislative changes over the course of this year, including talk of rent caps being a bit of a threat to things. But definitely rental reforms have been on pretty much every state and territory's agenda, not just Victoria's. So I think you know two big ones.
I'll take it. I think that's probably the one where we all did the best. It was nice to cross the finish line together in unison on that one. I think I didn't expect, and I do never expect rent caps to be actually legislated, but I just do think that the conversation around them is actually harmful. It kind of shows that there is a lack of intelligence around how this would actually play out if it was to be legislated. So, 2025, I think it's safe to say there will be some harebrained ideas in and around intervention into property markets, as there probably will be every year that we're all still alive. Let's move on to the construction side of things here. And I'm really disappointed in myself not sort of throwing an estimate into the numbers here, because I've been talking about it on stage and in podcasts for a long time. I was out to lunch on this one. Dave, you said governments are going to try and find ways to provide greater tax breaks to developers. It could be becoming a very good time to be a developer. We just actually had big Victorian builder go into liquidation, I think, this last week. I don't think I agree with you. There's been around about, I think, a third of all liquidations in Australia in the last 12 months have been in the building and construction sector. So just from a supply-demand point of view, there's going to be a lot less competition. But I don't think it's a great time to be a developer just yet. What do you reckon?
Look, I think, what did I say? Find ways. It could be becoming. I think probably becoming is the key word there. It's the beginning of the wave. The wave is gradually building up as it rolls its way in to break on the shore. We've definitely seen legislation put in place in different states to make it easier to build. There's been legislation in New South Wales, Victoria, Western Australia to make it you don't have to jump through as many hoops to build, medium to high density apartments or low rise apartments in Victoria, for example, around certain hubs within a certain distance from them. WA have allowed the sort of the mid tier level of council or that needed to approve developments. You're allowed to skip them if the size of your development is higher, which WA certainly needs more of. They've got the lowest percentage of apartments as a ratio of apartments to properties of any capital city in the country. So, I think we've seen that. I think that's what I'm talking about, as opposed to, I guess, those falling over at the other end of what I would say would be the end of what we saw with the government boost with the funds for renovating and developing. Yeah,
it's been a big year for construction in Australia. I think you could probably throw the build to rent incentives into those developers' incentives, Dave. We've also seen a big change to contracts where really every sort of standard residential construction contract now has a provision for the movement of material prices, because that's really kind of what did everybody in during COVID. These construction companies are trying to essentially buy work to trade through COVID, to keep all of their trades fed, to keep themselves moving along. And, if you're doing it at a 7% margin and timber goes up 25%, you're in trouble pretty quick. Kate, you made
It's actually somewhat surprising, isn't it, that they didn't already have that built into the contracts?
Well, I think it's easy to say in hindsight, but we've just never have seen a shock in recent history that kind of would have cauterized the damage from that. So, yeah, it's a bit like...
Yeah, I'm surprised, though, even with, say, the inflation of the late 80s, early 90s, that didn't adjust contracts at that point in time. That has flowed through and continued on to this day. I just would have thought it's an industry that's been around forever, but I guess
I just don't think we've ever seen that materials cost surge, and the freight component and materials shortage. It really stunned.
What we've seen in the past, and you can actually go through construction reference manuals and look at quarterly indices. There's the building price indices that come out each quarter, and you can go all the way back to the 80s, and you can see little blips where there's been certain things like cyclones that have kind of destroyed timber production, and you can see those kind of blips. But this was kind of like really every material we were in trouble, because I think somewhere around 60% of our construction materials come from overseas. We do have domestic timber, but there's some arguments to say that we haven't sort of kept pace with that. But if we're getting 60% of our stuff from overseas, and not only are there those increased costs of moving shipping containers, but you've also got these production facilities that were shut down or they were run on skeleton staff. So it was a global shock like we've never really seen in terms of how modern trade works. Kate, you made a point about when Brisbane's games are sorted out, they too will probably have builders returning to work. I think what people don't necessarily understand with the struggles with building houses is that there's two things at play that are pulling people away. One is the disasters, extreme weather events where insurance companies can afford to get tradies in parts around the country because the cost of rehoming people is so high that they'll pay top dollar. And then we see this huge pipeline of government infrastructure stuff. I mean, all of Victoria has been dug up for the rail. We've got rail from Brisbane to Sunshine Coast. We've got the Badgerys Creek second airport. I mean, every city seems to have a pipeline of big infrastructure projects. Of course, you mentioned the games as well.
Yeah, well, I know just how hard it's been getting tradies in Melbourne with our big build, and as you said, we're not the only city that's undergoing huge civil infrastructure.
And we also limit the number of people we bring in from overseas migration in that area as well, so that holds back the number of workers.
Yeah, very true. Not introducing new talent from
and the CFMEU have been in the news this last year, so big shout out to them. A small shout out. I don't want a horse's head on my pillow or whatever happens. I made a point about the pipeline of higher density residential having dropped, and I mean that wasn't necessarily a prediction. That was kind of what I was seeing, and then just talking about the desperate need for innovation. I think the construction sector is kind of a little bit behind the times, and there are a lot of probably actors that are invested in the status quo and things not changing. I think there's huge opportunities for modular buildings. There's huge opportunities for off-site construction to be assembled on site. There's huge opportunities for robotic technologies and different polymers and those sorts of things. But it will kind of require some pretty solid R&D concessions from the government and perhaps some visionaries that see that as a space that they want to go into. But I think dwelling approvals, we talked a lot about the housing accord, the 1.2 million homes that we need to build in the next 5 years. That started 1 July. That equates to, I think, 240,000 homes a year. And we're not going to get anywhere near that. So I think that's probably all we need to talk about that, unless I'm missing something.
One key thing.
Mm?
It's interest rates. You know, the holding costs on sites has been so prohibitive, and it's the big ticket item at the moment. We talk about developers and, you know, tax breaks from the government, but holding costs are so much tougher than they were, obviously, when we had a record low interest rates. And, you know, a lot of projects aren't feasible. They're just not stacking up.
Yeah, I think the regulation as well for building and the high standards we set for so many different aspects of the build, and that actually also slows things down significantly, means there's more hoops, you know, just talking to builders that they need to jump through. It adds extra expense as well, so it makes it harder to run at a profit. So I mean, you know, there's some areas where we possibly could lift standards, but then there are other areas where the standards are probably prohibitive to profitable developing.
There's two standards, I think. One is a standard that stops people dying on site. Those are all things that we can get behind. And then there are just standards for standard's sake. And I think red tape is the big problem. And, you know, the governments that are clipping the ticket along the way, we talk about, you know, a new, let's say, house and land, you know, we're talking, you know, 50% of that, the cost of that being state and federal taxation, which, you know, until we can stop getting sort of drunk on our own supply, the states can't really assume to be making big changes in housing supply.
Yeah.
Interest rates. Oh, I just scanned down to my one and, that's going to sting. Anyway, Dave, we'll start with you. I think there's a possibility we'll have one more rate rise, and I think there's a possibility there'll be no rate reductions next year. I mean, it's better than what I said. But can you cast back your mind to that point in time and how it kind of contrasts with the data and the sentiment today?
Yeah, well, I learned a lesson where my expectations for inflation had differed from my expectations from what would happen with interest rates. So this time I aligned the two. And although I thought inflation would fall back into the target band in the last sort of quarter of the year, give or take, it wouldn't be enough for interest rates to be reduced. So I thought, I thought it was less likely that interest rates would fall during the year. And I did think there was a possibility they could go up, because at the start of the year or the end of last year when we made these predictions, you know, it was still holding its line, if you like, at a higher level than people expected. And if we, you know, the RBA only took off the table the possibility of interest rates going either way, up or down, only sort of 1 or 2 meetings ago. So
yeah.
So I linked it to what I expected would play out in inflation, because I've learned that lesson in these predictions previously.
Good.
Where I didn't connect the two.
You got away unscathed, I think. Kate, you said, I don't think we've got any more rate increases coming our way. I think it'll be static for a large part of the year next year. I don't know. I think I'm going to have to give that one maybe to you rather than Dave. I mean, you didn't necessarily call that there wouldn't be any change. You said large part of the next year, but I mean, the word static, these are all compelling arguments for you winning this one.
Yeah, I remember it when we recorded our predictions, and I thought that inflation was still problematic, but like steering a big ship. You know, if you turn the wheel too tight, it starts running the other way, and then you've got to play catch up. So I thought they're keeping everyone at bay with their words of caution, and everyone was fearful. You know, is there going to be another rate increase? When will we have a rate cut? We just didn't really know, and I think what Governor Bullock's done really well is kept the messaging consistent without scaring too many people. But I've got to hand it to her. She did not deliver any false hope. She's been very consistent, reminding us that a rate cut's not around the corner, and that's probably been a sensible thing to do, given the fact that inflation's been problematic and what persistent has been her wording. And the reason I said static for a large part of the year next year is because we've learned through through the recent history that predicting interest rate movements in a short space of time can be really dangerous, especially having like a long range prediction that covers all. When our past governor dared to say that there'll be no cuts until, what was it,
2024.
Yep.
Yeah, and got him in hot water and arguably cost him the job. So I don't think anyone can really predict what will be happening in 12 months' time, but I think it's fair to say what will be likely to happen in 6 months.
Can you think of a job where ostensibly Governor Bullock did nothing, but was flat out all year? Isn't it weird? Like there was no changes, but it was a busy year for the RBA.
What I really admire about her is if you read the questions that the journalists ask once they make their speech, she's very rigorous and actually had a comment that was so relevant for every single curly question she got. I haven't seen a single answer where I thought, I don't pay that. And the number of variables that they need to consider beyond what we're just looking at, headline inflation, and occasionally we talk about unemployment, but there are just so many facets, and it's very impressive for all the geeks out there that want to have a look at the board meeting questions. They're great. The journos ask very good questions, but her answers have been on point every time.
Yeah, I agree. She's done well, and I don't think I answered that question, so we'll move on.
So Mike, I think we might end up getting a cut in the August meeting. And I remember you saying, why did I say August meeting? I'm going to be hung out to dry for that, predicting a specific month. But
yeah. But you know what? If that was the one cut and it was in August, you would have looked like an absolute hero.
Worth a shot.
You just put it all on black, didn't you?
I did, and you know what? Like, it's a technique that I'm looking forward to throwing at 2025 as well.
Let's see what Easter eggs you've got for us.
The clock is.
The thing is, if there was a drop in August, there almost certainly would have been at least one more fall, because they generally don't make one fall at a time. It's almost always so. He sort of left that out there as well. What was to come after August?
So funny.
It was worth a shot. All right. Rents, vacancy rates. I think you had a bit of a win on this one a bit earlier as well, Dave, but you said vacancy rates will stay at similar levels. Unfortunately, we might see a slight uptick, but they're going to stay pretty similar around record lows. Rental growth, I think, will outstrip capital growth. So you did get that by a couple of percentage points, and the slight uptick, I mean, in the November data, I think we went by 0.1% upwards. So, I mean, that is a masterclass, I think, from you, Dave.
Look, nationally it went from 1.1 to 1.4 November 23 to November 24. So there was a slight uptick. It just felt like, can it really get any lower? Formation rates are adjusting. People are, moving in with other people to save on rent. And we'd been talking about that at the end of last year. Yeah, so I got it. I don't think it was rocket science necessarily or Nostradamus like to land it, but it's always nice to get a win.
Better than I do.
You've got to take my correspondence course on dispensing with modesty, Dave. But well done, Kate. You said, I feel we'll have a lot of pressure on rents, particularly in Victoria. What were you thinking about at that point in time?
I thought that our vacancy rates would get tighter and our rental growth would continue in the same trend that it did in 2023. So I was wrong there. Rents did ease for all of the reasons that you mentioned, Mike. And I think we've been, in the thick of it here, looking at all of these reforms and ridiculous things that have caused investors to leave the market. And it's hard to have a national focus when you're working specifically in one state, and in particular only a couple of cities, and I've really felt it here in Victoria. But the message there is that things that peak, they generally do start to ease. It can't go on forever, but we've seen yields increase, which is obviously showing what the relationship is now between median price movement and rental movement.
So,
All right, who wants
Mike,
to?
I think we'll probably start to see Perth moderate with rents. So that's a tick. I think capital growth and rental growth will probably be fairly close together. So I'm going to give that a tick.
Yeah.
5.8% v 5.5%. So
Oh,
well
Yeah.
done, which doesn't normally happen. So yeah, and in terms of the Perth rents, the annual change in rents in houses for the previous year was 12.9. It came down to 8.7. And for units, Perth was 16.3 down to 9.7. So yeah, two tick for you.
yeah, it didn't
Well done,
drop
Mike.
as much as well. Sydney was basically the same, but yeah, it didn't drop as much as Melbourne. So I didn't necessarily zero in on that. But yeah, I think I'll take that one. Some of my best work, for, at least for this one. Sales volumes and listings, guys. Dave, you said I think listings will continue to rise in 2024, and I think we're going to see some of the pain come out of the economy really play out in 2024.
Yeah. Has anyone heard the saying cost of living crisis?
Yeah.
Yeah, I think that's been the big news story. I think we pretty much just have data on sales volumes, which were mostly up. The listings volumes we only have for the last 4 weeks in November. So if we look at the graph, though, it looks like listings are also above the 5-year average. So yeah, I think I did all right on that. I just figured with the difficult times that we had with the high rates, cost of living challenges, we'd see more sales take place and listings. So that's played out to some degree.
Kate, you were saying we'll have higher sales volumes in the first quarter, and by mid-year they'll be lower than the 5-year average. Did we see a blip in the beginning?
Not really.
Oh, so I
It's
actually wasn't
interesting.
sure now. It feels
No,
like I've
you know
dumped you in
what?
it.
The agent, no, I've been chatting to some of my BA buddies around here, and the agents threw us a curveball early last year because we had 2 years down in Melbourne where we just worked through the break. So that normal time when everyone takes a holiday and doesn't work in early Jan, we worked right through. I think I literally took off just Christmas Day, Boxing Day, and I still fielding calls because we'd had such a crazy time with lockdown activity and we'd had that huge boom year. We all just were happy to work. We were happy to take the work. And the agents were all telling us previously that they had large sales volumes and that they were all going to be putting in that same work effort at the beginning of this year. And I didn't really want to work through Jan last year. I felt like I deserved a break. But a lot of us came back to work early because the agents had talked it up. And it wasn't just me, it was across the board, certainly down here. So their talk of lots of listings and all of this stock and all these investors that are selling, it was probably a bit more hyped up than reality. So we didn't see that sales volume surge. So I was influenced by news on the ground, which was not all that reliable this time.
Nice to hear some Victorian agents overquoting instead of underquoting. Big shout out to my soon-to-be not friends in the real estate sector in Victoria.
Yeah, good on you, Mike.
All right, so
now you said there'll be people that have held off getting things ready for the new year. The prices won't perform as well as people's expectations, and then people yank things off the market. Well, that's an interesting thing that you've said because we did have a lot of sales that were withdrawn, particularly at the start of the year. We had quite a few vendors out there that had lofty expectations, and if you don't have to sell and the market doesn't meet your expectations, well, the obvious thing is that you'll take property off the market.
I'll call that a pass then, if you'll allow me.
Yeah, interesting thing to note. We had, in terms of listing and sales activity, it wasn't breaking any records at all. In fact, we had a bit more listing nationally than the 5-year average after the first quarter, so counter to what I was suggesting. And in terms of total listings, we're still trailing under the 5-year average, but we're very much in sync with last year's numbers.
That's interesting.
Yeah. So sales volumes were up 8% for the year up to November, that is. And listings, we only really have the numbers for 2024 in November in here. But we do have the graph, which shows,
Interesting.
the black line is above the 5-year average for listings nearly
New listings.
all of the year. Yeah, for new listings,
Yeah.
sorry.
But interestingly, for all listings, which includes stuff that's been hanging around a long time, including old listings, it's significantly under.
Yeah, it's sort of it's significantly under the 5-year average, isn't it? It's around in line with the year before, which just says the absorption rate. There's not lots of people buying the older listings, is there? With rates so high, it's sort of just in equilibrium to what it had been in 23 and 2022, give or take, isn't it?
Yeah.
For total listings, even with extra listings coming onto the market.
Let's move on to our final two, because this has been a bumper episode. The risks that could impact the market. Dave, you said the biggest risk to anyone who believes in democracy is Donald Trump getting re-elected. Russia overpowers Ukraine and wins that war. Wow. Big
That
calls.
goes for the big ticket items each time.
Yeah, well, I look the big picture and then come back step by step. The macro world ultimately narrows back to impacting our economy and then our property market. So you've got to look at the big picture.
Yes.
Look, I've got an open mind to Donald Trump, but, I think there are risks there. I know that we've had one person slay me on the ratings for us giving Donald Trump a hard time or something like that. So
yeah,
I'm very conscious.
We're conscious that we've been told to stick to our lanes.
Yeah. We had one star rating from someone saying that. So
I think what we can say is that Trump has hit the ground running talking about tariffs on China, and there's plenty of economists are saying that is actually a negative thing for Australia, given their massive global trading partner. So the results of Trump, I don't think, have really hit the Australian economy as yet.
Well, they've hit nowhere yet, have they?
Yeah.
He hasn't taken power. They're saying that'll be likely to be inflationary, which means higher rates for longer, and bond yields have gone up, particularly in the US, post Trump winning the election.
Okay, I think that there'll always be people that don't enjoy three property specialists talking about their political views, and it's something that we have to take on the chin and put the views aside. But we're looking at some of the things that we can read, in the economy, and we're looking for commentary around things that we can genuinely be concerned about or look forward to, and that's the role that we play when we talk about geopolitics.
Yeah,
exactly.
So I don't know if that was a 1 star for Dave. See if you can just nudge it up for a 4 after that balanced appraisal.
Look, I've got an open mind to Donald.
You weren't singled out, Dave. We the three of us were called jokers.
We all got a tally.
Like a lovely reviewer.
Kate, you said the effect of natural disasters domestically on our insurance and the flow-on effects for investor selection and also where people are choosing to live. Interestingly, the RBA has shared all sorts of commentary in and around insurance costs. We saw the government insurance rebate, and insurance has been one of those things in the basket of goods that has really pushed inflation along. So I'm going to give that one to you for sure.
Oh, thanks, Mike. You said political intervention is the number one risk to perverting the market. Specifically, what were you thinking?
Well, whether that was borne out or not is another question, but I still believe that it's concurrently the biggest risk. And I mean, you've just got to look at Melbourne as a case in point. The political intervention that started with the minimum standards legislation and the land tax, and you guys, led the charge with, I think, vacancy taxes back in the day as well. And the net result is the market has suffered. We saw when the Queensland land tax was legislated, around about a 17% reduction in investors, according to our data, buying in Queensland as opposed to other states. So I really just felt like there was so much opportunity to get this wrong. I think Melbourne has got it wrong, and Victoria's paying for it.
Yeah, very fair call.
All right, the last one. And I mean, this is going to sting because we already sort of talked about RBA movements, and I absolutely biffed that one. But inflation, Dave, you said inflation, I think it's going to keep coming down, but we may not actually hit the target band across a quarter until the back end of the year. By the end of the year, we'll be back inside the target band of 2 to 3%. It's not a bad effort.
Yeah, I think that probably nailed it, actually. So essentially, we hit that target band in that last quarter. This monthly CPI indicators, came down in between 2 and 3% towards the end of the year. So
it's the trimmed mean that they talk about, though, and that's, we all got excited when we saw the headline rate, but what the RBA look for when they take out the volatile components, it's still sitting above 3.
Yeah, that I was thinking about that when reading your comments, Dave. In you take one measure and you've nailed it, the other measure, and it's sort of like, well, you're still perfectly on the right track, but slightly outside.
Yeah, no, that's a fair call. The trim mean is slightly above 3%. Yeah, in September and October.
I think for next year's predictions, we're going to have to specifically say trimmed mean.
Yeah. Well, that's the measure that the RBA counts. So really, that's the one that counts.
Yeah, yeah.
Kate, you predicted that.
I didn't quite get it.
Close though.
It was pretty good, Dave. I think you've won this one, Kate.
At least I didn't sit on the fence like you two did with most of your calls.
Rude.
Here we go. Well, listen.
Your gloves are off.
If you are hovering above the 1-star button,
we
give
got
Dave a shout out for this.
We're going to make specific calls next year, guys. Come on.
Kate, you said, I do predict that things will calm down with inflation, and I think it will happen reasonably quickly. I mean, I've had a couple of clangers. I think you can probably maybe add that one to your basket.
Yeah, well, I sort of calmed down, but it didn't happen quickly. It's taken the whole year, and we're still not
sticky.
There.
Yeah,
consistent.
The word's been sticky. Okay. But yeah, it definitely did calm down. And then, again, I don't think I
you might have got
answered that one.
You threw in a probably.
I don't know if we'll hit the target band next year. I think it's still probably going to be a 2025 thing, unless globally things change. So, I think relative to the trim mean, which Kate rightly pulled me up on.
Pretty nitpicky of me. Sorry, Dave.
It's not bad, Mike. Not bad. It's a good sentence. And the sentence, is pretty much right.
Yeah. I'll be a good politician with sentences like that. All right. Well, I'm sure all of that data will be available to peruse in the show notes. And because we've had such a bumper episode, I'll say goodbye to you guys. But of course, stay tuned because our 2025 predictions will be happening in the next little while. So check your local guides for that. But it's been a pleasure reviewing the year that was with both of you guys. And congratulations for the ones that you've nailed and a bit of homework to zero in on for 2025, I think, for all of us. But thanks for joining us.
Great
I think the overall mark 7 out of 10 for the three of us.
I think that's fair.
Around there.
We'll find out in the iTunes comments anyway.
That's right.
See you next week.
All right, catch you later.